Welcome back to the Deep Dive. We're here to cut through the noise and give you some clear insights. Today, we're diving into something really interesting in finance. How bond investment income actually behaves through, all the economic ups and downs. How does it affect your portfolio?
And specifically, we're focusing on the LionGlobal Short Duration Bond Fund, the active ETF SGD class.
Exactly. What caught my eye straight away were these claims. Singapore's first active bond ETF and the first listed share class of an existing fund. Big claims.
They are significant firsts.
So what does that actually mean for how this fund works, how it navigates the economy?
Right. Our goal today is really to help you, the listener, understand how a fund like this tries to deliver both capital growth and income. We'll break down its two main parts, the price or NAV and the dividend payouts, and see how they react in different economic situations.
Okay.
We're using detailed analysis of bond fund behavior plus specifics on this fund to give you a balanced picture, strengths and things to watch out for.
Sounds good. So before we get into the economic cycles, maybe we can simplify things a bit. How does a bond fund like this actually work? What are the key bits we need to get our heads around? You mentioned two moving parts.
Yeah, exactly. It helps to think of it in two main dynamic components. First, there's the price. You'll often hear it called the net asset value, or NAV. This price moves around mainly because of external things like interest rates and credit spreads.
Credit spread says that's like the extra bit of yield you get for taking on more risk than, say, a super safe government bond.
Precisely. If rates go up, existing bond prices usually fall, and the opposite happens if rates go down. That impacts the NAV. The second part is the dividend, the income it generates. This mostly comes from the coupon payments of the bonds inside the fund, and also the yield the fund gets when it reinvests money from maturing bonds.
Okay, NAV and dividends. Got it.
Understanding both is really key to seeing the whole picture, the total return you might get.
Right. Okay, let's put these two parts, NAV and dividends, through their paces. How do they actually play out under different economic conditions? We've got, 5 scenarios? Let's start with one that worries a lot of people. High inflation, central banks hiking rates. What happens then?
Okay, yeah, that's a common concern. So high inflation, rising rates, central banks are trying to cool things down, right?
Right, hiking rates.
For the bond fund, this generally means existing bond prices fall. Why? Because new bonds coming out offer higher yields, making the older ones look less attractive.
Makes sense. So the fund's NAV, it drops.
It can dip, yeah, probably modestly, though. The fund's short duration nature acts like a bit of a cushion compared to longer-term bonds, which would fall much more sharply.
Okay, a cushion.
But here's the interesting part, maybe a bit counterintuitive. While the price might take a hit short-term, think 2022, when rate hikes globally did cause dips, it's actually setting the stage for potentially higher income later.
Higher income.
Because as older bonds mature, the fund reinvests that money into new bonds at those now higher yields. So over the medium to long term, your dividend stream can actually increase. We saw that follow through in 2023 and 2024.
Huh. So short-term dip in value, but potentially more income down the line.
Exactly. It's that classic trade-off. Potential short-term capital dip for a longer-term income gain.
That is an interesting dynamic.
Yeah.
But, for someone really focused on keeping their capital steady now, that initial dip could still feel uncomfortable.
Absolutely. It's about understanding that volatility is part of the process to potentially achieve that higher future income. It requires a bit of perspective.
Right. Okay, what about the flip side then? Inflation falling, central banks cutting rates.
So when rates are cut, maybe to boost growth, the picture flips. Existing bond prices actually rise.
Because the older bonds with higher yields look better now.
Exactly. They become more valuable in a lower rate world. So the fund's NAV tends to climb, sometimes quite quickly, especially right after cuts are announced. Now, short-duration bonds like these will rise, but maybe not as dramatically as long-duration ones.
In the dividends, what happens to the income stream?
Short-term, the dividend payout might hold up okay because the fund still holds those older, higher-yielding bonds. But longer-term, as those bonds mature and the money gets reinvested into new bonds at the lower current yields, the dividend payments will likely decline over time.
So this is what you sometimes hear called the short-term gain, long-term pain for income investors.
That's a good way to put it, yeah. You might get a nice boost to your fund's price, the NAV, but your regular income could shrink down the road.
Okay, short-term gain, long-term pain. Got it. Now let's tackle the tougher times. What about a recession?
Right. Recessions. Growth slows, worry about defaults goes up. It gets a bit more mixed here. Typically, government bonds do well. Investors see them as safe havens, right? So demand pushes their prices up.
Like running for cover.
Kind of, yeah. But corporate bonds. That's different. Prices there might fall because people worry companies won't be able to pay their debts, credit risk, default fears.
So the fund's NAV could swing.
Yeah.
Maybe drift down a bit because of the corporate bonds it holds?
It could, yeah. A mild downside is possible. Now, dividends. If defaults stay generally low, the income might remain fairly stable, but could slowly drift lower if central banks are cutting rates, which often happens in recessions. But if defaults really spike, then yes, dividends could be cut and the NAV could fall more noticeably.
Okay, but you mentioned something specific about this fund.
Yes, an important point here, the LionGlobal fund primarily holds investment-grade bonds. These are generally considered safer corporates. So while not impossible, an extreme collapse in dividends is much less likely than you might see in a fund focused on riskier high-yield bonds.
That investment-grade focus sounds like a significant buffer then. A bit of a safety net during storms.
It aims to be, yes.
Okay, let's switch gears to happier times. An economic boom. Strong growth, companies doing well. What then?
Right, boom times. Companies are generally healthy, default risk is low. That's good for corporate bonds. Credit spreads usually tighten, meaning the extra yield for risk shrinks because things feel safer.
Oh.
However, central banks might start thinking about hiking rates to stop the economy from overheating. So that could put a little downward pressure on bond prices, or maybe they just stay kind of flat.
So NAV might be stable, maybe slightly pressured. What about dividends?
Dividends could actually gradually rise. As money gets reinvested, it might be going into bonds with slightly higher yields if rates are starting to edge up. And because default risk is low, the income stream is generally pretty stable.
So for investors, maybe steady dividends help offset any slight drag on the NAV.
That's often how it plays out, yes.
Yeah.
Relatively stable overall.
Okay, one more scenario.
Yeah.
The tricky one. Stagflation. High inflation and weak growth. Whew. How does the fund cope with that double whammy?
Yeah. Stagflation is tough. It's like getting hit from both sides. High inflation tends to push bond prices down because future payments are worth less in real terms. And weak growth increases worries about credit risk, especially for weaker companies.
So NAV under pressure. Volatile.
Generally, yes. NAV is likely under pressure and could be quite volatile. Dividends. Well, there could be some short-term strain if companies in particularly stressed sectors struggle. But medium term, similar to the high inflation scenario, as the fund reinvests, it might pick up bonds with higher yields driven by that inflation, which would help support the income stream over time.
So income might hold up okay eventually, but the price losses could easily outweigh that in the short run.
That's a distinct possibility, yes. It's a challenging environment for most bond funds.
Okay, we've painted the picture for bond funds generally across these cycles. Now let's really zoom in on the LionGlobal Short Duration Bond Fund itself. How do its specific features, short duration, active management, being an ETF, actually play out? Let's talk strengths and then the potential downsides.
All right, this is where the specifics really matter. Let's start with the pros, the strengths. First, as we touched on, lower sensitivity to interest rate changes. Its short duration average 2.25 years as of late July 2025 means its price doesn't swing as wildly when rates move compared to longer duration funds. Less volatility.
That duration number, 2.25 years, gives a concrete sense of that sensitivity, doesn't it?
It does. Second, you get diversified exposure. It holds a mix of Singapore and global bonds, mostly investment grade, across different sectors like financials, real estate. The info suggests around 200 different bonds in the portfolio as of July 2025.
So not putting all eggs in one basket.
Exactly. Third, there's a long track record for the underlying strategy. The fund itself, the underlying unit trust, started way back in 1991. And apparently it delivered positive returns every calendar year since 2012, except during those sharp global rate hikes we mentioned.
That's quite a history. What about yield?
Fourth, a reasonable yield. The portfolio's yield to maturity, the YTM, was around 3.18% in local currency terms as of July 2025. That's often better than cash or money market funds, giving you income without jumping into super high-risk territory.
And you mentioned different share classes.
Right. The weighted YTM for the SGD hedged ETF class was 2.66%, while the unhedged USD class was higher at 5.51%. It shows how currency and hedging choices affect the yield you actually see.
Okay, other pros.
Fifth, active risk management. The managers aren't just passively tracking an index, they're actively adjusting the mix, credit quality, duration, government versus corporate bonds, trying to adapt to market shifts.
And finally, the ETF structure itself.
Yes. Sixth, the ETF benefits. Being Singapore's first active bond ETF means things like potentially better liquidity. You can see the price change throughout the trading day and possibly lower costs. The management fee is 0.25% a year for this ETF, compared to 0.50% for one of the unit trust classes. Plus, accessibility, you can invest from just $1 per unit.
That's a pretty compelling list of advantages, especially if you're after stability and income. But okay, let's be balanced. Every investment has risks. What are the cons or things people should really be aware of here?
Absolutely crucial to look at the other side. First, it's not immune to interest rate risk. Short duration dampens the effect, but it doesn't eliminate it. Sharp, unexpected rate hikes can still cause the price to fall.
Okay, reduced risk, not zero risk.
Precisely. Second, credit risk is still present. Even though it's mostly investment grade, it holds corporate bonds, including in sectors like real estate and financials. These can become vulnerable if the economy really sours.
Right, makes sense.
Third, expect modest returns compared to riskier options. This fund is built more for defense, for stability. You're likely trading off some potential big gains you might get from equities or longer duration bonds in really strong markets, and it can have negative returns sometimes. There was a max drawdown noted of negative 6.8% as of August 2025 in one class.
So manage expectations on growth. What else?
Fourth, fees and costs. Active management, while potentially adding value, usually costs more than simple passive index tracking ETFs. 0.25% is competitive for active, but still a cost. Fifth, currency risk. It does have some non-SGD exposure. It looks like about 0.2% in USD as of July 2025. Currency swings can impact your returns, even if there's hedging, because hedging isn't perfect and has its own costs.
Okay.
Sixth, in a scenario where rates fall sharply, the gain might be limited. Yes, the price will likely rise, but probably not as much as longer duration bonds would. So if you're making a big bet on rates plummeting, this isn't designed for maximum upside there.
That's not built for that specific bet.
And finally, seventh, just to reiterate, drawdowns are still possible. It's not like putting money in the bank. It's not risk-free capital. There can be periods where the value dips.
Okay, that's a very clear picture of the pros and cons. So pulling it all together, who is this LionGlobal Short Duration Bond Fund ETF really for? Who's the ideal investor, and maybe who should look elsewhere?
Good question. Thinking of the investor profile, it could be a really good fit if you're looking for, say, a parking place for some cash, somewhere that aims to offer a better yield than maybe your savings account or a basic money market fund, while still focusing on preserving your capital, relatively speaking.
Okay, a higher yielding cash alternative, sort of.
Sort of, yeah. Or if you're building a diversified portfolio and want some fixed income exposure, you want that income and diversification benefit, but you're wary of taking on too much risk from long-duration bonds, especially with rates uncertain.
Makes sense for a balanced approach.
And also, if you specifically want income, perhaps in a stable currency like SGD, especially in today's, uncertain global climate, it could benefit from holding bonds bought when rates were higher, even if rates start to fall.
Okay, and who is it less suitable for?
Well, it's probably less ideal if you're really chasing aggressive growth or if you're comfortable taking on high volatility for potentially higher returns. Equities or maybe higher risk bonds might be more your style then?
Not for the thrill seekers.
Probably not. And also, as we said, if you want to make a strong bet on interest rates falling significantly, you'd likely get more capital appreciation from longer duration bonds.
Right.
And finally, if you have zero tolerance for volatility, if even small dips in value are unacceptable, then this, like most bond funds, might not be the right fit. You'd need something with guaranteed capital, perhaps.
So it really deals down to prioritizing stability and income over chasing maximum gains and accepting some level of potential fluctuation.
That sums it up well. It's about finding the right balance for your own goals and risk tolerance.
This has been an incredibly thorough deep dive. We've really unpacked how bond funds work in different economic weather and how this specific LionGlobal Short Duration Bond Fund ETF tries to navigate it all. It's clear that the features like short duration and active management offer potential benefits, but as you said, come with their own trade-offs and risks. That balanced view is so important.
Indeed. And stepping back, it really highlights that a bond fund isn't just a static number, right? It's this dynamic portfolio constantly reacting to the economic environment. What's interesting here is how this fund uses its specific strategies, the short duration, the active management to try and smooth out some of those bumps, aiming for that balance between generating income and preserving capital.
And for those listening who might be interested in the practical details.
Right, some logistics. The initial offer period, the IOP, runs from September 8th to 23rd, 2025. It's set to list on the Singapore Exchange, the SGX, on September 29th, 2025. You'd typically access it through brokers that offer SGX trading. The tickers are SBO for the SGD class and SPV for the USD class.
Okay, SBO for Singapore dollar, SBV for US dollar.
Correct. And you can use SRS funds to invest after it lists, but just a note, you can't use your CPF ordinary or special account money for this ETF.
Good to know those details. So for you, our listener, hopefully this deep dive shows that being truly well-informed means digging deeper than just the headline yield number. It's about understanding how an investment is designed to behave, how it might react in different futures, not just its past performance.
Exactly. That understanding is crucial. Which leads to, perhaps, a final thought for you to consider. As the global economy and interest rate landscape keep shifting, how might you reevaluate your own approach to seeking income? How do you weigh that complex interplay we've discussed between interest rates and the fund's price, or NAV, and the dividend stream you receive in funds like this one?
A really important question to ponder. Thank you for joining us on the deep dive. We hope this exploration has given you valuable insights for your own investment thinking. We'll get you on the next deep dive.